Hello and welcome to Portfolio Matters Weekly Update, week 57. And once again, it's been a very interesting week, particularly in terms of economic data. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Thank you, Richard. Well, news this week. Last Friday, after Portfolio Matters had been recorded, we got US non-farm payrolls, and they were great. They were much, much stronger than expectations. If you remember, in last week's weekly, we were talking about the possibility that non-farm payrolls would come in at about minus 150,000. Well, they didn't. They came in at plus 467,000. We'll go into that in some detail. Yesterday, US inflation came in hot. Against expectations, it continued to rise, hitting 7.5%. It has led to expectations of accelerated interest rate rises from the Fed and a bit of a sell-off in the equity markets last night. In other news, a UK team has managed to sustain nuclear fusion for 5 seconds and created enough energy to boil 60 kettles. And actually, that is real progress, because if you think of fusion happening on the nanosecond scale, 5 seconds is a very long time. And fusion would solve our energy crisis. So this is great news. In other news, Russia continues to rattle its saber and has been adding troops to the Ukrainian border. But as yet, there's no war. Long may that continue. Okay, so going through some economic data. And this week, we'll talk about the non-farm payrolls, which were great. So January number came in at plus 467,000 versus expectations of only plus 30,000, massively beating it. In addition, the US participation rate ticked up, again exceeding expectations, and was at 62.2%, above expectations of 62%, and hourly wages increased at an annual rate of 5.7% against expectation of 5.1%. All that is very good, and we'll go into it in some detail. In addition, the US inflation rate exceeded expectations, hitting 7.5%, above December's 7% and beating expectations of 7.1. So inflation continues to run hot. And the last piece of data we'll cover this week is that new UK's car sales rose by 27.5% in January, compared to expectations of minus 6.3%, and in December, sales were actually down by 18.2%. So that suggests supply chain difficulties are easing, and that's really important. And as you will see as we go through the weekly update, the return of car manufacturing is very good for platinum group metals. Richard, charts.
Thanks, Keith. This is the graph of the Eurozone interest rates, which we actually discussed also in the Eurozone crisis piece that we put out a little bit earlier this week. But it's showing the rapid increase in Eurozone bond rates, which could have significant impact on many things financial. And US non-farm payrolls showing that very good result in January. US average hourly rate wages continuing to move upwards in line with the increase in price inflation. And obviously one of the questions here is, where does it stop? And we don't know the answer to that question, but I suspect that given that wages lag price increases, it it's not going to stop for a while, even if price increases, so the rate of price increases slows down. US employment participation rate is actually showing signs of life and moving back up towards maybe what was the mean for the 7 or 8 years prior to the pandemic, although it's got a little way to go yet. It's moving up quite sharply now.
So, Richard, can I come in on this? This is the January jobs report. And what was important about the jobs report was not just that it came in hot, but they revised upwards their previous figures for all the months since August by quite large amounts. So if you look at the chart on the left here, the blue bar is their latest estimate. The grey bar was the original estimate and was the data we would have reported on this podcast. And you'll see these revisions are not small. They're very big. And behind all this was an adjustment in the estimated size of the population and of the workforce. If you're interested, I provided details in the little box here. But the net effect is they've increased the total size of the workforce and include so both employed and unemployed people, but including much more people in the labor force. This is the US balance of trade, which continues to be astonishingly bad and must be balanced by capital inflows. And the US dollar continues to be actually quite strong. So the US is continuing to attract lots of capital despite the sell-off in the NASDAQ. So watch this space.
US initial jobless claims seem to be have leveled out in the last few months at around about the 200,000 level, suggesting sort of the employment market is perhaps stabilizing in the US now. Well, obviously we saw the participation rate is increasing fairly significantly. And continuing jobless claims, this is a weekly chart. And the thing to remember about this chart is it's based at 1.5 million. So although it looks tiny in January, in fact, it's not tiny, but it is much less than it was, say, in March 2021. And the China Services PMI is continuing a steady downward trend, still above 50, but not looking particularly healthy at the moment. And the composite PMI basically reflecting a similar sort of picture, I think.
Thank you, Richard. Okay, on to Inflation Watch. And we had new data from the US this week, which, as we reported, came in hot at 7.5%. Now, you'll be aware that the US still has interest rates at 0 and is still doing QE. It's meant to finish doing QE next month. So as a result of the hot inflation, the market is now worried about the Fed raising rates very quickly. And various Fed members have come out in the last 24 hours calling for rapid rate rises, an initial rise of 0.5%. So, and this was last Friday when Euro interest rates, expectations of Euro interest rates rose very quickly. And we're going to cover in coming weeks what happens in the Eurozone. But please watch our piece on the return of the Eurozone crisis, because this has important ramifications. And we showed earlier how the participation rate was rising. And what this chart shows is how there's a good correlation historically between wages and the participation rate. And now the red line, which is the wages, is significantly above the blue line, which is the participation rate. And if this correlation holds, you would hope that high wages will pull people back into the workforce and the participation rate will continue to rise, which would be great for both economic growth and for reducing wage inflation.
Producer price indices for selection of construction materials. So some of these prices increases are extraordinary. So solid construction timber up nearly 80%, and rebar steel up 60%, and resins and so forth, which are manufactured from oil products, fossil fuels, up nearly 30%. Metals we cover all the time and significantly increased. So the total producer price index is 10%, but the construction industry is experiencing much greater inflation in Germany than the producer price index, which suggests there's actually a lot of inflation still in the system and still to come through. And the inflation impulse from rising oil prices will fade. Well, it will fade assuming oil prices stop rising, clearly.
No, actually, no, sorry, that's what this chart is showing, Richard, is that the pace of the rise in oil is going to slow. So, it's doubled and from its pre-COVID lows. And so if you look at it in percentage terms year on year, which is how you measure inflation, then the change in oil prices is going to slow. And that should bring down inflation.
Because the absolute increase in oil prices was very significant around about 12 months ago, and that will drop out of the inflation index shortly.
Yeah, that's right. Exactly. So this chart is showing that during lockdown, obviously restaurants, etc., were closed and people couldn't go on holiday. So they tended to spend their money on durable goods rather than services. And the black line is durable goods expenditure, which is extraordinarily high as a share of income. And as restaurants and travel reopen, you would expect durable goods consumption to fall back towards trend. And that hopefully should ease supply chain bottlenecks and ease inflation, we hope.
The US is forecast to have the highest inflation in 2022. But where do these numbers come from, though, Keith?
So this chart is from the Visual Capitalist, and all the numbers are from the IMF. But
so, how much credence do we give this data, given that we know that economists in places like the IMF have consistently got prospective inflation levels wrong?
Well, a very good point, Richard. I mean, we've covered this in the podcast many times, how economists' forecasts for inflation are little better than a monkey chucking darts at a dartboard. So, but I think what's interesting is the IMF are forecasting that the US will have inflation of 3.5% next year, which is the highest amongst developed nations. And to my mind, it's just no coincidence that they've printed the most money and done the most fiscal. I mean, this is not difficult.
I'm just dubious of the projections full stop. I mean, it shows an extraordinary level of precision in a very imprecise science.
That is absolutely true. But I mean, you have to give a number. So they have,
Yeah. Well, okay. Interesting to understand the mindset of the IMF, if nothing else.
And a reminder, we are expecting inflation to peak in the coming months, but to remain persistent, not to be transient, particularly if the labor market remains tight and wage inflation continues. Okay, a short segment on central banks are trapped. And this has been prompted by one of our viewers, Andy. And I intend to do a longer piece on this, but I got distracted during the week by doing something on the Eurozone crisis. So we will do that at a later stage. But so here, a brief summary. So these are US public debt levels, and you'll see they're absolutely extraordinary. They're the highest they've been in peacetime. UK public debt is approaching 100% of GDP. This is the Eurozone, and we covered this in our piece on the Eurozone crisis during the week. Greek debt to GDP is above 200%, Italian above 150, Portuguese, Spanish around 125, French above 100, Eurozone as a whole approaching 100. So during COVID, everyone piled on debt, and that puts central banks in a very difficult position because they have an inflation mandate and they should be aiming to keep inflation at around 2%. And in order to do that, they need to raise interest rates. But if they raise interest rates, so governments will have to pay more on their enormous debt burden. And as their interest rate payments rise, they will then have to either divert money from their social care or their general budget to pay for interest, which is deeply unpopular in Western democracies, or they're going to have to either print money, which is inflationary, or default. So there are no good options for countries if they have rising interest rates. And therefore, there is a conflict between the need for independent central banks to apply their mandate and raise interest rates, and the need for governments to have low interest rates to balance the books. And as a result, central banks are trapped. They raise interest rates too much. Governments of the world face a solvency crisis, financial crisis, enormous global recession, etc. If they don't raise interest rates enough, then inflation is persistently above target and they lose the confidence of the bond market, and bonds sell off anyway because rates rise, particularly at the long end, in which case governments face a solvency crisis, financial crisis, global recession. And to illustrate that, I have done some original research. So, total Italian government debt, November 2021, 2.7 trillion, which is 154% of GDP. Now, in 2022, Italy is forecast to have government expenditure as a percentage of GDP of 52%. In 2020, it spent around 57 billion on interest out of a budget of, let's say, 840 billion. Now, the 2020 and 2021 budgets were much bigger because of COVID disruption. I'm going to assume it's going to go back towards 2019 levels. As a result, interest payments as a percentage of its revenues was around 6.7%. A 1.1% rise in Italian yields, so 1% of 2.7 trillion is 27 billion, and that equates to 3.2% of its 2019 expenditure. So you'll see a 1% rise in the average interest on Italian government bonds would increase its interest bill by around 50% and require it to divert around 6% of its budget from general expenditure. And is that doable? So you see that highly indebted nations are very sensitive to increases in interest rates, and small rises can cause big effects quite quickly.
Just to chip in here, it's not just highly indebted governments, it's also highly indebted corporations, which suffer precisely the same problem. And there are plenty of those knocking around.
Yeah, absolutely. And I particularly like this quote. Central banks are independent within government, not of it. And so who appoints the governor of the Bank of England? The government does. And so central banks, when push comes to shove and it's choice between enforcing their mandate and destroying government finances, or being seen to talk about enforcing their mandate without actually doing anything, I suspect they're going to do the latter. So expect lots of talking about, getting inflation under control without too many interest rate rises, would be my bet, Richard.
Yeah, no, I would agree with you, Keith. I think interest rates can't rise for the reason that you pointed out, but also interest rates need to rise to control inflation for the reasons you pointed out. So as you say, they are in a complete bind, and it's actually very difficult to predict what the route out of this. And as you put in the previous slide, either way, given that there's so much government debt and it is rapidly becoming unserviceable, either way, the outcome is some sort of financial crisis at some point. And the ECB have managed to kick the can down the road from the Eurozone financial crisis 8 years and counting. Will they manage to kick it down the road another 8 years? I don't know. I think it's impossible to say.
I personally think they'll manage to kick it down the road until the next recession. When fiscal deficits expand again, that's when you generally have solvency crises, not when they are improving.
Can we just do a quick thought experiment there, Keith? So if you're under recording your rate of inflation officially, which I suspect countries are, then the real GDP growth is less than recorded. So if you're under-reporting your rate of inflation, then you're over-reporting your real GDP growth. You're manipulating your real GDP growth higher by under-recording your rate of inflation. And if the differential between the actual rate of inflation and that reported is large enough, your real GDP growth can go negative when you're in fact in a recession when you're reporting that you're not. If that's happening, and technically countries are in a recession, does that affect does the absence of understanding of what the real situation is affect the outcome?
Absolutely it does. Yes, no, absolutely. That would be a good way of retaining the confidence of the markets. So underreporting inflation reassure bondholders that you're not inflating away the debt when in fact you are.
So this is why inflation is being underreported. I realise that is a debatable statement on my part, but there is a big incentive for governments and central banks to underreport the rate of inflation.
Yeah, now, I agree with that, but I think in democracies, Western democracies, there's a great deal of independent checking, and you can argue about the calculation they do, but I think it'd be very difficult to systematically lie about the level of inflation. But actually, can I share my own conspiracy theory before we move on, Richard? In that, if you look at the minutes of the last Bank of England meeting, you'll see that two governors dissented and said that they thought the Bank of England should have raised rates by 0.5% rather than 0.25%. And that is just the sort of news you would expect to come out of the MPC meeting if they were trying to convince markets that they were really going to be aggressive about getting inflation under control, but they didn't actually do it. And I expect similar pronouncements come out in every Bank of England meeting going forwards.
I'm sure you're right, Keith. It's a good cop, bad cop of central bankers scenario, isn't it?
Yeah.
I'm sure. Rates.
Yeah, I'm sure they sit down and say, right, how many of us are going to call for a 0.5% raise this month, without actually having to do it?
Yeah, I'm sure you're right, Keith. So a little bit on financial repression. So financial repression basically is where the government, by stealth, takes money from individuals. And the issue that Western governments have is they're so indebted that in some way there has to be some form of financial repression if the debt levels are ever going to be reduced. And so this is US federal debt as a percentage of GDP. And as you can see, it's over 120, or just about 100%, 20% now. This level of debt, it simply can't be repaid without a huge amount of pain to the economy. So the easiest thing is to have an inflation rate that is higher than the interest rate, so the value of the debt gradually reduces. So this graph shows a century of US debt as a percentage of GDP. So it was pretty high in the late 1920s with the banking crisis. As Keith pointed out, there's yield curve control during the Second World War. And then the non-federal debt as a percentage of GDP hit 300% during the Great Financial Crisis. And it's now around about 250%. But the federal debt as a percentage of GDP is well over 100%, 120%, as we saw above. So the absolute debt levels are really very high. So this is a projection by the Budget Office, US Budget Office, which is suggesting that the federal debt not held by the central bank, which is currently around about 100%, it's going to go up to 150%, which means that there's an awful lot of debt to be sold into non-central bank hands over the next few years. And there's a question mark as to how you can do that when the rate of interest is so low. So what's this graph showing, Keith?
Well, it's showing the blue line is the monetary base and 3 month is the treasury rate. And it's simply making the point that they've been printing a lot of money, interest rates are very low, and real interest rates are highly negative. And in order for the debt to be sustainable, your point, Richard, that the interest rates need to remain both below GDP growth and below inflation, so well below nominal GDP growth, which they are. They're at essentially historic lows in real terms. And the high debt burden suggests that will linger. That will in order to maintain the debt, they're going to have to try and keep that as negative as possible for as long as possible.
So holding cash and near cash equivalents means that you will be suffering a real capital reduction every year for as long as real interest rates are negative.
Yeah.
Which we think is going to be a long time.
On that note, the US Fed has a lot of bonds on its books, which it bought during QE. Now, QE is due to end. So this is the size of the Fed balance sheet, and you can see it absolutely shot up during COVID, and it's continuing to rise. It's due to rise. It's due to end next month. Now, the Fed has said that it is not going to do quantitative tightening. Now, quantitative tightening would be selling the bonds it has on its books back into the market. And that would have the effect of taking money out of the financial system and raising interest rates. And it doesn't want to do that. So what it said is that it will simply allow maturing bonds to fall out of the book. So when the bond matures, they won't reinvest the money. Now, thank you very much to our American viewer, Herman, who sent me this spreadsheet, which is his own work. And what it shows is the maturity profile of bonds held on the Fed balance sheet. And you can see, actually, it mainly holds a lot of short-term bonds. And that is bad because that means when those mature, the US government is going to have to sell new bonds into the market. And so there's potentially quite a lot of new issuance coming from the US government, and that could be bad for market rates.
And just sort of, if you cast your eye over this, you could do a sort of very rough interpolation, I think, Keith. It's a very interesting chart. You can say probably over the next 3 to 4 years, something like 1/3 of the Fed balance sheet will mature.
Yep. So having gone from a period where, actually we covered this in the weeklies, that the Fed was not issuing any new treasuries because the Treasury General account was so enormous, suddenly they're going to reverse and they're going to have to issue a lot of new debt, and that's going to suck liquidity out of financial markets.
Yeah. As Keith spoke about right from the beginning of the introduction, we know that Russian forces are amassing on the Ukrainian border, threatening to invade, threatening that disturbed that NATO is basically encroaching upon Russia's security. And so the question is, how vulnerable is Russia to Western sanctions, which have been threatened should Russia invade Ukraine? Because from a military standpoint, it's almost impossible to stop them from invading the Ukraine. So first of all, can Ukraine fight back? And I think it's worth noting that Russia have put a large proportion of their armed forces onto the Ukrainian border or in reserve. So they are putting a substantial chunk of the red up against Ukraine. And clearly, in terms of military personnel, airplanes, helicopters, tanks, armored personnel carrier, field guns, and ships, Russia totally outguns the Ukraine. So if Russia decided to invade Ukraine, the Ukrainians could do nothing to stop it. And I guess the only thing that the West could do to stop it would be to start launching nuclear weapons. And I don't think that's likely to happen.
Yeah.
I certainly one hopes not. So it can, if it wishes, invade Ukraine. It's then subject to international sanctions. So the blue line is Russia's international reserves, which have gone from not very much at all in 2015 to over 600 billion US dollars now. And the red line is gross foreign debt, which has gone in, picking 2015 again, has dropped by around about 30%. But the main point is that the differential is no longer indebted. It has a surplus in its international reserve account. So if sanctions are imposed, it doesn't need any foreign income to continue to service its debts. And this is a very interesting chart. So the ruble in yellow and Brent crude dotted line, it's sort of, the value of the ruble has tracked quite closely up until the late teens, the price of Brent, and then it started to decouple to an extent. And for the last 2 years, it is entirely decoupled from Brent crude. And it looks as if it's about 50% undervalued in terms of its international status as a major fossil fuel exporting nation. So I guess the point here is how much further can the ruble actually drop, given that it's so undervalued already.
And also, if tensions with Ukraine eased, the Russian assets look extraordinarily cheap.
And Russia's central bank, to avoid US dollar sanctions, it's basically moving out of its dollar holdings. It's halved its dollar holdings in the last 3 to 4 years. And it is taking the euro and the yuan. And as we know, Russia and China seem to be diplomatically much closer than they have been previously. To the extent almost that I think they are trying to develop a sort of a Sino-Russian new currency regime, which would effectively isolate them from the US dollar and isolate them from any potential financial sanctions by the US. And the US has, of course, been throwing its weight around significantly with financial sanctions since Obama came to power, really threatening to remove countries from SWIFT. And foreign holdings of Russian government debts are high. And we've just looked it up, and Russian government debt yields around about 8.5%.
The interest rate, the current interest rate is about 8.5%. So before we go, I'd just like to thank our Discord member, Migraine, for his contribution on the charts on that section. Russia does not seem to actually be that exposed to European and Western sanctions. How vulnerable is Europe to Russian sanctions? Well, if we look at the energy dependence of Western countries on Russia, it's really high. The Czech Republic, Latvia have 100% of their gas supplied by Russia, and much of Eastern Europe is very dependent. Germany has over 60% of its gas supplied from Russia. So if the Russians decided to cut off gas, that would be very bad. And Russia also exports lots of critical materials, palladium, which is used in catalytic converters, amongst other things, vanadium, which is strengthened steel, and astonishingly 1%, adding 1% vanadium to steel doubles its strength. Phosphate rock, so that is potash, big fertilizer, more on that later, etc., etc. The world uses a lot of resources from Russia, although these days we don't do much trade with Russia. So trade with Russia has halved essentially over the last, come down 40% since 2012. And while we're on this subject, potash. So this is the price of potash, free on board Vancouver, and you see it's quite quiescent, which is odd because Belarus, which is the subject of Western sanctions, is the best part of 20% of world supply. So if that's offline, how come the potash price hasn't gone through the roof? Well, the reality is we are rubbish at doing sanctions. So we imposed sanctions on Belarus, the EU did, after Belarus sent its fighter jets up to intercept a Ryanair flight and take off a dissident and throw him in jail. But I didn't know this, sanctions only affected new contracts, not old ones. And sanctions only affected around 20% of Belarus's potash exports. The trouble is that the EU has 27 nations, some of whom have, important trading relations with Belarus. And in order to get any sanctions package passed, you need unanimous agreement. And so you get the bare minimum. And that's the bare minimum. And so when we talk about sanctions on Russia, are we any good at this? Okay, on to other charts. So this is the markets. The dashed blue line is the market's expected path of interest rates. And you'll see they're expecting that interest rates will not rise above 2%, and the red line is the expected path of inflation. So continuing our discussion earlier about central banks are trapped, markets are not expecting interest rates, real interest rate, to be above zero at any point in the next 15 years. So
there's a bit of a dichotomy, isn't there? Because one of the issues is people who prognosticate about the rate of inflation say, well, if you look at what the market's expecting through interest rate differentials, its market is expecting inflation to drop back down to 2%. But the other way of looking at it is that the market realizes that central banks can't raise interest rates no matter what happens to the rate of inflation. And therefore, your presumption about what the market thinks is going to happen to the rate of inflation is wrong. And I actually tend to subscribe to the latter point of view, that central banks will try and hold interest rates down for the reasons we've discussed, but that is not an indication of what is going to happen to inflation. Inflation is effectively decoupled from interest rates.
Yes.
It is now, and will remain so.
I strongly agree, Richard.
No, so these charts show that everybody has lots of money. So household cash holdings in the US are about 10%, very roughly above trend. The bottom 60% of household net worth has climbed very dramatically. The cash holdings, bank reserves are the highest they've ever been, and it's perfectly obvious that QE is basically what is driving US bank reserves, and that's probably not healthy. And bank deposits versus loans are extraordinarily high in comparison to sort of the historical norm of somewhere around about 100 to 110%. So there's a lot of cash in the system, which we know because although the Fed denies there've been money printing, the Fed has been printing money.
We're at an inflection point in the economy now, and we have quite a lot of commentary which kind of extrapolates trends and talks about, is it the economic growth going to slow now based on the charts, etc. And so my thoughts are that actually what these charts show is that US businesses and consumers have got loads of cash, and they're now going to be free from lockdown, having had 2 years in which they can't go on holiday, and they've had limited ability to go to restaurants and cinemas, etc. And I think we could have a huge boom. The people just want to go out and have a good time, and they have the resources to do so. So I think extrapolating from the historic trends over the last couple of years could be misleading.
And if you're right, Keith, that will stoke inflation.
Yes.
This is the chart that we show you from time to time of German power price 1 day ahead. And it has risen from the sort of summer of 2020, from around about 60 to where it is now, 165. So roughly gone up 2.5-fold. The huge peak has declined. But the issue here is this structural energy problem that we have at France. Nuclear power stations, some of them have had to go offline for repairs, which we've talked about in the past. Germany is burning a great deal of coal, and we're importing a lot of gas from Russia for our energy needs. And the wind and solar has been ineffective this winter because the wind dropped and it snowed. So there was no wind and there was snow on the solar panels. And Europe has a real structural energy problem. And I read yesterday, I think, that Macron is planning on building another 6 nuclear power stations in France. But the issue really is that in order to retain its economic competitiveness, Europe does need to resolve its energy problem.
Absolutely. So energy prices high, and frankly, unless we sort it out, they're going to stay high.
It also makes it very difficult to be internationally competitive.
Yeah. So this is a chart of US earnings over the past 50 years. And what it shows is that globalization has been very bad for wage inequality. So the top 10%, in real terms, their wages have risen over 150%, whereas the bottom 50% have had what, 20% pay rise in real terms? So if we are now rowing back from globalization, then perhaps this gap will close. And we've seen in previous weeks how wage inflation for the bottom 50% has been growing much faster recently than for the top. Now, in other news around the world, we talked previously about how emerging markets had piled on a lot of debt during COVID. Well, Sri Lanka may be on the brink of default. So a lot of these emerging markets nations are highly dependent on tourism. And so during the pandemic, they loaded up on debt, as did all governments around the world, but their tourist revenues have dwindled. So a wave of emerging market debt defaults is possible. Watch this space.
Wow, the UK will need to import 70% of its gas by 2030. So the giant gas fields that we had in the North Sea are all gone.
Yeah.
And I know we've started importing a lot of liquefied natural gas from the US now, haven't we? There is a bidding war between Europe and Asia for US LNG, which is very good for the United States because it has plenty of gas.
Yes.
But it makes us very vulnerable.
And it'll also be very bad for our balance of payments and for sterling.
So COVID, well, the number of Omicron cases in the US is plummeting, having spiked. I mean, I think that basically Omicron's, without wishing to minimize the effect it has on people who it does make ill, for most people who get it, it's a little bit like having flu, and economies can live with it. So lockdowns are beginning to, and COVID restrictions are beginning to end everywhere. And the question is, what's going to happen to the economies of the world when effectively they all come out of lockdown, assuming there's no nasty new variant that comes out?
Well, I think people can now go out and return to their normal daily lives, we hope, and that should be great for the economy.
Yeah. So the onto the weekly checklists, the equity markets, the FTSE all share up 1.5% last week. Stocks Europe, S&P 500 all up. Nasdaq had a bit of a bounce despite being down 11% on the year, and the topics likewise had quite a healthy bounce. Bitcoin had a very large bounce, which although I don't have Bitcoin, I have Ether, that had a similarly large bounce, which is nice for those holders. The pound is pretty much unchanged against the dollar, whereas the dollar index has risen 0.7%. Still well within its trading band, I think.
So this is a chart showing, and something we've covered many times on the weekly, how as interest rates rise, long duration assets like tech and growth companies tend to underperform, and value companies like energy companies tend to do very well. And you see there's a very strong correlation between the performance of value companies and interest rates. Now, this is interesting. Share buybacks in 2021 were absolutely enormous.
A lot of share buybacks are made out of debt, aren't they? And if interest rates do rise, that's going to make share buybacks a lot more expensive.
That is a very good point, Richard. You're absolutely right, because I thought they were paying it out of earnings, but of course they're not. They were taking advantage of very low interest rates to load up on debt and buy back shares.
Yeah. Thereby boosting their earnings per share and their own bonus payments.
Precisely.
Companies are guiding down their earnings expectations. I think yesterday Unilever came out and said that it was under extreme margin pressure, with input costs causing its margins to drop dramatically, increasing input costs. And obviously that has two consequences. One is it issues lower earnings guidance, and the second consequence is it will seek to put up its prices, which will fuel inflation. And this is very interesting because so many companies are guiding down earnings expectations. And we've got we're now into negative territory, i.e. earnings reductions. And that suggests that input prices, given that the economies are generally doing well and that GDP is generally doing well, despite our prior discussions this morning, that suggests that what's causing this is margin pressure, which is going to result in inflation coming through the system, which is one of the reasons I don't buy the fact that inflation is going to magically drop back down to 2% over the course of the next few months.
Companies will attempt to pass on very high input inflation. In fact, weren't you saying in a previous weekly, Richard, that Spanish input price inflation hit 30%?
I think that was November. I haven't actually seen it since then. I haven't looked, to be honest. But yeah, 30% in the, it was extraordinary. And that's a year-on-year increase. Yeah.
And high yield bonds are starting to sell off. So there's an absolutely extraordinary bubble in high yield bonds as investors hunted for yield. In Europe, high yield bonds yielded essentially zero during the lows of COVID. And now it seems that markets are regaining their senses and proper credit default risks are once more being priced into the bond market.
This is a classic chart of where people's psychology is in comparison to the rate of change of prices of a stock market or a company. Where are we now? Well, we are where the arrow is pointing, which is we had a bounce. And the question is, are we going to go back up to the new paradigm? Or are we going to go back down? Are we going to go down to despair? And the classic cycle of this is it drops down to despair. My only caveat is I don't think central banks will let that happen.
You see, I disagree, Richard. I don't think the central banks are going to be able to do anything about it because interest rates are rising. The NASDAQ valuations of the NASDAQ are absolutely idiotic. And people bought those shares because they were going up. And essentially, once they start coming down, there ain't no reason to hold them. You want to get out as soon as you can. So I agree with you in the long term, Keith, but I think the central banks will have a jolly good go. And if they have a jolly good go, they'll have to do it through reducing interest rates and QE. And really? This is all part of the trap that they've got themselves into. Okay. Well, if they do that, it'd be very good for the stock market, but I don't think they can halt a crash in the NASDAQ. Let's see what happens.
Yes, but either way, you shouldn't invest on the hope that the central banks will step in. So this is a log chart of Ethereum, and I just thought it was interesting. As you know, I like this log chart, and then it broke through the log chart quite dramatically, and it just shows the consolidation, or whatever you might like to call it, of Ethereum. I still hold Ethereum, and the chart doesn't look great, but notwithstanding that, I still hold it.
Well, the other thing I'd say, Richard, is it shows the danger of drawing lines on graphs.
It does, doesn't it? Yeah, it does indeed, Keith. And by the time the line is any use, it's halfway done anyway.
Yeah. Moving swiftly on. Right, energy commodities. So, oil had a bad week, down 2.2%, but has extraordinarily elevated levels. It's come off in the last couple of days. EU natural gas continues to drift back down towards more normal levels as Russia, as we reported last week, started supplying Europe with gas again, which is great news all round. However, the coal price is up 30% this year, i.e. in 6 weeks? Now, I have added a whole new section at the bottom here, which those of us who are heavily exposed to oil, these are really important numbers. So these are US oil plus petroleum inventories. And last week, they fell by 9.4 million barrels, and we'll go into this. So essentially, inventories are continuing to draw down hard. US crude oil production started the year at 11.8 million, and this week it recovered to 11.6. There's been a cold snap in the Permian, which has impacted production, which is getting back towards normal. And the rig count continues to rise steadily, but unspectacularly, only two rigs on the week, given oil prices are at $90 a barrel. So this is crude, off a bit in the last couple of days, but that's been a great run. And frankly, a pullback was more than overdue. This is the rig count. You can see it's just steadily climbing, and is nowhere near its levels in 2018, when the oil price was well below where it is now. So US shale producers really are being very controlled. Now,
is there a maximum rate at which the rig count can go? Is there some sort of natural rate limiting factor? Because there's a sort of that line is a fairly constant gradient.
Yes, it is. But if you look back to what happened in 2016, 2017, which
quite a lot steeper.
It was a lot steeper.
Yeah.
Now, this is the EIA's forecast for global oil production, and look at the red wedge, which is Brazil, because it's odd. So they're forecasting that in April and May, you're going to get a huge increase in Brazilian production, which is going to fade. If anyone can explain this to me, please get in touch, because other agencies are not showing the same trajectory for Brazilian production. If you look at Brazil 2022 on this chart from global data, you'll see it's forecast to rise only 250,000 barrels. So what's going on? If somebody can let me know, I'll be very grateful. Now, the EIA, as we have covered in previous weeklies, has been forecasting that the oil market will go into surplus in 2022. If you look at the chart top left here, you'll see there's an implied stock build from February 2022 onwards. But if you look at what's causing that, they're essentially saying world oil consumption is going to stall in the first half of 2022, which is just absolutely mystifying. As COVID restrictions ease, fully expect people start driving and flying again, economic activity to pick up. I think they're wrong. So this chart shows the same picture from the EIA, and they're essentially saying they're expecting builds starting next month. If you look at these numbers from OPEC, though, they are saying that there'll be drawdowns in the first quarter, a slight positive balance in the second, and then big drawdowns towards the end of the year. So the OPEC are forecasting big price rallies in the oil price towards the end of the year as we get continued inventory drawdowns. Again, this is from the IEA, and they're forecasting, weirdly, demand to drop in Q1 2022. And that's behind their forecast of inventory builds.
That is very strange, isn't it? That they've both got either a plateau in demand growth or demand drop without any particular reason as to why that should be the case.
Absolutely, and it's just doesn't fit with the facts. So this is US diesel demand roaring back, now at new highs. This is Heathrow Air passengers, which I think is really interesting. So having completely collapsed for 2 years, international air travel is coming back, and it's coming back fast.
And interestingly, it hasn't had the dip that the national domestic travel had.
Yeah.
The Omicron dip.
And these are US distillate fuel stocks, and you'll see they're starting the year at very low levels below their 5-year range. And what is interesting and very bullish for oil is that at this time of year, you shouldn't really be getting inventory drawdowns. You should be getting inventory builds. So this is historic oil inventory figures for the US. And you'll see in most years, so 2015, for example, which is this purple line, you see very strong inventory builds in the start of the year. In all the other lines, apart from 21 and 2022, you get builds in the first half of the year. And so the fact we're getting inventory drawdowns now is unseasonal and potentially quite bullish for oil. So this is Dutch natural gas, which is drifting off, we hope, and coming back towards more normal levels. But obviously, if there is war in the Ukraine, all bets are off. Now, another thing that happened this week was in the UK, we got Ofgem's revised energy cap, and it's not good. So UK energy bills will rise from 54%, from £1,278 to £1,971 in April. Now, the UK government intends to soften the impact by essentially giving domestic customers a loan of £200, discount up front, which will be repaid over 5 years. And it will subsidize, there'll be a rebate for homeowners with smaller houses. So the net effect is owners of smaller houses will get £350 off their enlarged bill. But you'll notice the UK government has done absolutely nothing to address the underlying supply issues. Their effects are essentially to subsidize energy use and energy demand, and therefore keep it up. And therefore, the net effect of this will be to keep demand high and prices high. Now, this is heating demand in Europe, and part of the reason that the natural gas prices come down in Europe is that it's been warmer than usual. So you haven't actually had to use as much gas as normal. But gas inventories are still drawing down. And if we got a cold snap, we could still be in trouble. And I thought this was interesting. So essentially, there are now so many transatlantic LNG cargoes heading from US to the EU that nobody wants them anymore. One of the things is, compared to traveling across the Pacific, it takes much less time to travel across the Atlantic, and so you can recycle the ships faster, and there are now more ships than they need. In Puerto Rico, with the US, which is supplied by LNG, their gas prices have spiked because Europe is diverting LNG cargoes from everywhere, including Puerto Rico in the US. Thank you to Migraine from our Discord channel for that. And also for this chart, we have covered in previous weeks how German energy policy is rather contradictory. And so one of the things they have ruled out is fracking on German territory. And so fracking would be possible in these light green areas, but they banned it. And now they're intending to import LNG from the US.
Very clever.
So
do we know why the price of coal has spiked like this, Keith?
I think the Chinese are burning loads of it. And essentially, Germany's burning loads of it. Natural gas prices have spiked. And so, we have diverted natural gas from all around the world to Europe. What are they going to do? They're going to burn coal.
Yeah.
Uranium has reached a permanently high plateau, as Irving Fisher would say. And you'll have seen that France has committed to build 6 new reactors with the option of building a further 8, although the first one will be operational in 2035, i.e. 14 years from now. So won't impact uranium demand anytime soon, but it's an indicator of which way the wind's blowing. Richard.
Yeah, thank you, Keith. So a bit of a mixed week in commodities. Aluminium up 6.8% and 17% year to date. Other big movers, iron ore up 23%, nearly 24% this year, 2.4 in the week. Lithium, a quiet week for lithium, only up 1.3%, 36% year to date. And magnesium down 12% on the year. Moving in the opposite direction to aluminium, actually, although magnesium is used in aluminium alloys to increase strength to weight ratios. Neodymium has had a very good start to the year, and obviously demand for that is mostly electrification of the world. Nickel has had a good start to the year, a good week. Tin is actually, for a change, going nowhere, and ferrovanadium has had a quiet week as well. So aluminium looks like it's on quite a sustained uptrend at the moment. It's taken out its October peak and is moving strongly upwards. As we've discussed before, aluminium uses a vast amount of electricity for its manufacture. Cobalt has stabilised. I was reading today that cobalt is no less rare than tin. It's just that we've never really needed it. And so there aren't any cobalt mines, which is interesting. But suddenly demand has risen massively. Copper looks as if it might be getting itself ready for another price increase. Yes. Chromium is dropping back down from its large rise. Iron ore, I don't really understand why iron ore is going up. I think I would have thought that the contraction in the Chinese construction industry would have had the opposite effect to this.
Although, of course, Ukraine is a big exporter of iron ore, and also the Chinese smelters are back in full operation.
Yeah. Lithium basically continuing its meteoric rise. Magnesium going nowhere much at the moment. Neodymium on a very steep upward trajectory. And I think those of you who are invested in rare earth miners, generally speaking, their shares seem to be doing quite well at the moment as a consequence of the price rises. Nickel is looking very strong. And I think we've discussed previously that there is an impending shortage of nickel in the world's metal exchanges, isn't there, Keith?
Yes. Well, we should, next week, actually, we'll try and look at what the inventory levels are.
Yeah. Tin basically is on this meteoric upward trajectory. Just paused for breath this week. And ferrovanadium has been very quiet, actually, since summer of 2019, really. We shall see. So on to precious metals. Gold and silver had a decent week. Platinum, not a very good week. Rhodium had a very good week, but it is also very volatile. Palladium had a poor week. Gold is potentially consolidating for a move. Could be in either direction. Silver is doing something quite similar to gold, really. Platinum, I mean, Keith, you said that with car sales in the UK, which the UK is only a small part of the world market, if car sales increase around the world with internal combustion engines, then platinum, palladium, and rhodium will all be in demand for catalytic converters. Just very volatile.
Yeah, but I mean, rhodium is really needed in diesel engine catalysts, and I think this is evidence that demand's coming back.
Yeah. And palladium, I think, is palladium used in petrol engine catalysts? I'm not sure which way around now.
But also, I think the trouble is with palladium that 46% of production's in Russia, so the price is flying around depending on developments at the Ukraine border.
Yeah, very true.
Okay, finally onto rates. So it has been a big week in markets as US inflation came in hot. And you see that in the UK, we've had quite substantial rises in yields across the curve. Now, in Europe, there are big rises in Greek and Italian bond yields, and particularly the Greek yield is up. The 10-year is up 0.5% in 1 week. So that's an absolutely enormous change. Last week, it was at 2%. This week, it's at 2.5%. If it carries on in that trajectory, the Eurozone crisis is coming back fast. Please watch our video on this particular issue, which came out during the week. So after the ECB meeting last week, German bonds sold off hard. And a reminder that real yields everywhere are still deeply negative. And actually, the UK's bond yields since Brexit are the most negative of all. Now, this is the Greek 10-year, and frankly, the trajectory of the bond yields, that's not good.
Yeah, I think the absolute change is around about 400% increase since the summer of 2021. So 400% increase in interest cost. Now, clearly, that doesn't translate directly through to funding costs for government because it relates to debt maturity profile. But the absolute change is potentially really quite damaging to indebted entities. Likewise, virtually. And frankly, likewise for the UK 10-year.
So finally, on to the seasonality chart. And I'm afraid we are approaching the second half of February when traditionally we get actually one of the nastiest sell-offs in the year. You heard it here first. Okay, Richard, what were you up to this week?
Thank you, Keith. So I had a slightly up week, 0.3%. My change for the year is exactly the same as the FTSE All Share, which is 2.1%. I actually purchased a little bit more global uranium ETF. I am a long-term uranium bull, and the uranium ETF has come off a long way from its peak here in November. It was around about just over 3,000. It's 25% below that point now. Having actually nearly retraced all of its movement increase from August. So I just thought it was quite an opportune moment to top up my global uranium ETF holding. And other than that, I am sitting with my exposure to precious metals, fossil fuels, uranium, and not much else, frankly.
Oh, good. One of the stories they tell about John Maynard Keynes was that when he was managing the money of Cambridge University, that apparently, and this story may be apocryphal, he was very long corn futures, and the futures expired, and he had to take physical delivery of vast quantities of corn, which he then had to store in King's College Chapel. So, Richard, is there any danger that your vast quantities of uranium will mean that one day a huge truck full of yellow cake will arrive in front of, the house, and you'll have to explain to the wife why the radioactivities have gone through the roof?
The house will go critical, Keith. I hope not. I sincerely hope not. What we really need is somewhere with a cellar to keep it.
Oh, shit. Okay, thank you, Richard. Well, I had a decent week, up 1.6%.
Very good, Keith.
And I'm up 10.2% on the year, which is very nice. So my bet on oil is paying off, although I continue to find innovative ways to miss out on making money. We'll go into that. So I sold one share this week, which was the Oil Explorer Eco Atlantic. I made a profit of 34%, and regular viewers will know that after the disaster that was Advanced Energy, I'm systematically selling all my oil exploration companies, of which Eco Atlantic is one. And I've also sold all my BP, which has given me a lot of money to reinvest, and I have invested in all these. I won't go through them all, but I'd highlight Goldplat, which had results this week and is the only gold miner I know, and we did a podcast on it, and I recommend viewers look at that because it is a gold recovery expert that doesn't mine gold. It basically processes mine waste to extract the gold, and that means its energy intensity is quite low, which is quite important when the gold price is rising. And also I added to my position in Saga, the insurance and cruise specialist, which, as the market opens up for travel again, I'm hoping is going to recover. Now, this sadly is the performance of Pantheon Resources, which was drilling an appraisal well in Alaska. And in line with my new policy, I sold it here before the results came out. Tronar, great results, price up 50%. Rain falls on the just and the unjust alike. This is Eco Atlantic, and frankly, I just don't want to be in it. It's not an Explorer. I will wait until I've actually got some production before looking at it again. This is Goldplat. So I bought some more at 7p. Today it's spiked up to 7.5, but I find the results absolutely astonishing. So in Q4 alone, it made 2.36 million in profit. In H2, it made 3.8. It's got a market cap of 12 million. So on an annualized basis, it's on a P ratio of like 1.6. Now, it did warn about social unrest, etc., in West Africa and the possibility of coups upsetting its flows into its Ghana operations. But still, the shares are absolutely dirt cheap. This is Saga, which has insurance operations which have offset the costs of the loss-making cruise operations during COVID, and we did a podcast on it. The bottom line is they've kicked out the private equity owners. The member of the founding family has come back in. They're trying to turn around the culture. If they even remotely get it right, the share price could go up a long way. Now, we did a podcast on this, which is not one of our most viewed podcasts because it kind of lacks the pizzazz of some of our smaller exploration companies, but it's interesting.
I think one of the key features of that podcast, Keith, was the fact that the motor vehicle insurance premiums sustained the cruise arm, the holiday arm, if you like. And if Omicron goes away, we don't have any other nasty variants, one would expect the cruise arm to then move back into profitability, which would make a very big difference to the bottom line. And obviously there's a big if, because this is a sector that is vulnerable to COVID, but that is the sort of the risk reward, the nature of the risk reward on it, isn't it?
Absolutely. And for me, in my portfolio, obviously I own far too much oil. So this is quite a nice diversifier. So I've been adding to it. And that is it. So thank you all for watching. Please, can you press like and subscribe to the channel? And actually, I've forgotten to announce our next drinks. We'll do that next week. But in March, we will have another pub night. In the meantime, please, can you press like and subscribe? And it's goodbye from Richard Wheaton.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.